welcome to State of the World 2011, the show where we get you prominent economists who have been right about the 2007 crisis and whom we now ask about the key trends in 2011. Joining me today are Dr. Nouriel Roubini, by far the only one who called the bluff and the fluff of the US markets at their height, and Dr. Raghuram Rajan, who had equally shocked the hallowed precincts of the Jackson Hole Conference of Central Bankers in 2005 when he pointed to the accumulating risk in US banks. Dr. Roubini, Raghu, welcome.
Thank you.
To you first, Dr. Roubini, what's your forecast of the US for at least the first half of 2011? Do you think the second round of quantitative easing might be able to improve the US macroeconomic parameters?
In my view, the second round of quantitative easing is going to have more of an effect on asset prices. Stock market has gone up, government bond yields have fallen, the dollar has weakened. The effect on the real economy is going to be relatively modest. The best effect is that it reduces the tail risk of outright deflation and the tail risk of a outright double dip. So in that sense, it has a positive effect, but it's not going to lead to restoration of high economic growth because the problems of the economy are problems of solvency and excessive debt of the private and the public sector, and monetary policy can deal with issues of liquidity, not with issues of credit and solvency.
Raghu, if I may come to you with a similar question, if I have read your work right, you too have been doubtful of the efficacy of quantitative easing. How do you see the US economy?
Well, I think I've been one of the big skeptics about QE2 for a variety of reasons. One, I do think that we really don't know what it's going to do. Partly because the size of the bond purchases may have very limited effect, but they also create a fair amount of uncertainty in the markets. How much, when, what are they going to do to bond prices? And my whole view is that monetary policy is about as accommodative as it can get, and there's not much more it can do. If we push beyond this through these newfangled techniques like quantitative easing, we are venturing into areas we don't know that much about. There is a certain amount of room for fiscal policy appropriately directed, but really the big thing for the United States is that it's already in recovery. It's not creating enough jobs. Those will come. That's a matter of time. I don't think government policy can do that much in accelerating that process, partly because a number of the people who are out of jobs are people who are not going to get jobs as a result of cyclical recovery. These are construction workers, for example, who've been fired. And, you're not going to build that much more houses in the United States. They have to retrain, they have to move industry, that's going to take time. So I think we worried a lot about the unemployment picture here, but that's not going to be changed that much by changes in monetary policy. Maybe fiscal will do a little bit, but not much else.
But Raghu, fiscal and monetary authorities cannot do nothing when unemployment is in double digits or near double digits, not in a democracy. So the short point, do you expect a third round of quantitative easing?
No, I mean, my sense is that with interest rates having started to pop up again, despite all the quantitative easing, talk of quantitative easing, I think the central bank, the Fed, is going to be a little more circumspect about what it does going forward. Again, I would say, if you can't have any positive effect, doing nothing is better than trying to do something just to give the illusion of activity. I do think that we have a tremendous fiscal stimulus as a result of the deal that was announced between the administration and the Republicans a few days ago. That is going to kick in over 2011. My sense is more stimulus is unwarranted in 2011. 2012 that may wear off, but hopefully by that time we've got a full-fledged solid recovery, both in terms of growth as well as in terms of jobs.
Dr. Roubini, you are clearly not so confident as Raghu is. But let's discuss a slightly longer term. Do you think that there is still a real danger of the US getting into a near Japan-like slowdown that may last many years?
There is a risk, of course, that U.S. may end up with a long-term stagnation like Japan. I think that's a low probability event so far because the U.S. has been more aggressive than Japan was in terms of monetary, fiscal policy, and backstopping the financial system to avoid falling into deflation, avoid falling in a situation in which growth is close to zero. But we may reduce and avoid that tail risk of ending up like Japan, but we're going to have still this period of time where growth for 2 or 3 more years is going to remain anemic and below trend because you have to save more and spend less to reduce private and public debts and improve these damaged balance sheets of the private and the public sector.
Dr. Roubini, let me now come to the emerging markets. We have found that even an announcement of quantitative easing had led to a rush of money into risky assets like commodities and emerging markets through October. Now, when the dollar is actually printed and put in, perhaps all of that will happen in 2011. Do you see already asset bubbles in commodities or emerging markets, or do you think there is clearly an imminent danger of such asset bubbles in 2011 in these two asset classes?
Certainly, the fact that there are zero interest rates in U.S. and other advanced economies and there is more quantitative easing implies that this wall of liquidity is chasing assets. Some of them are commodities, some of them are emerging markets, but emerging markets are receiving capital not just because of short-term factors like interest rate differentials, but also because they have high economic growth. That's where the future of the global economy is. Countries like India, China, and others are going to grow very fast. So a lot of these inflows are more longer term, they're going to stay with us, and therefore that poses challenges how to properly manage these inflows, and it's a challenge for emerging markets, and there is a risk that if these things are not probably managed appropriately, eventually you might cause first fraud and then outright bubbles in some asset markets and emerging markets. So that certainly is a risk that they're facing, and whether they're going to get there or not depends in part on the policy response.
Raghu, more than asset inflation, commodity inflation seems already upon us. I mean, crude is at $90 even when the US and European economies are actually tottering. If there is a recovery in the US next year, as you are talking, is it a given that commodity inflation is going to be this big theme of 2011, at least for Asian countries, for India?
Oh, it has to be. It has to be. I think across the emerging markets, you see capacity constraints emerging. All the BRICS, except to some extent Russia, are facing serious capacity constraints. And I think that eventually this is going to show up in, and it's already showing up in some ways, in much higher levels of inflation. And I think since demand here is much more commodity intensive, it is going to show up in things like energy prices. It is going to show up in copper and steel and so on. And I think we should be prepared for this. I would argue that 2 steps we in India need to take very firmly are, one, ensure that we don't have any more fuels energy price subsidies, pass on all the prices to the consumer, else we will risk running up our fiscal deficit again. And that is extremely dangerous at a time when our current account deficit is running at 3.5–4%. And countries around the world are suffering, a loss of credibility on their government debt issuances. We are in a position of strong growth. We should use this to clean house and to prepare ourselves for potential shocks that might come down the line, which could be considerable.
Actually, you're sounding a little less bullish than some people in India. The country has managed an 8.9% GDP for 3 consecutive quarters. You fear this can't be maintained given the inflation? Will substantial interest rate hikes need to be made to rein in growth?
Well, substantial is a strong word. I mean, what you want to do is look at domestic constraints and see if, in fact, your pace of growth is fast and possible given the domestic infrastructure, given domestic labor availability in the sectors that are growing very fast and so on. Those are the kinds of considerations which will affect the monetary policy deliberation. And I don't want to comment on whether there should be much more in terms of rate hikes or much less. It will depend on the situation there and how the RBI perceives it. But I would say that this is a time of heightened risk for policymakers because partly of the large current account deficit in India, partly because the fiscal deficit is still large, partly because countries are experiencing greater concern about their finances. And if you just took a snapshot of India's situation, 3.5–4% current account deficit, large fiscal deficit depending on how you count, and relatively high inflation at this point, these are not numbers to be very happy about. What is offsetting all this is the high growth number, and it may even be contributing to certainly some of the inflation. So I would say we need to make these numbers look a little better over the next year or so to give us a cushion if in fact the world situation turns a little worse, perhaps because of financial problems in Europe, which seems to me the most imminent tinderbox, so to speak. But we need to use this growth that we're getting to set our house in a little bit better order, and I would hope we can do that.
All right. Dr. Roubini, what's your study of India indicating? Do you think that a near 9% GDP growth is a sustainable trajectory for India, or do you think the country will be actually tackling problems of overheating in 2011?
Well, I think that India could achieve a situation in which growth could be for many years 9%, even closer to 10%, without stoking a rise in inflation. But in order for that to happen, the potential growth rate of the economy has to be equal to the actual growth rate. So if the potential growth rate of India were to rise to 9% plus, then India can grow 9% plus without having a rise in inflation. And to increase the potential growth, you have to do all the economic reforms, like investing in infrastructure, in the skills and education of the labor force, reducing the constraint to private sector activity to increase the productive supply of goods and services, increase the investment and the capacity to produce more goods and services. So all the economic reforms that are necessary to increase the potential output of the economy. In that case, if those things are continued to be done, then you can have high economic growth and still have a modest inflation rate.
I suppose those are eternal truths, but they never seem to get done in India, at least not as fast as is needed. Well, Dr. Roubini, Raghu, we need to take a break.